What is a revaluation reserve and where does it come from? Hi, I'm Kimberly Shapcott, qualified chartered accountant, property investor and entrepreneur. Let's sit down and have a chat. Revaluation reserves, what are they? Where has it come from? Let's dive into what it is to start with. So a revaluation reserve is something that we tend to create when there is an increase in value in your properties. So let's say you've got a property you've spent some money on, you've bought, you've refurbed, it's now sitting in your accounts at 300,000. That's amazing. However, it's now worth in the real world out there 400,000. So we now actually have a property in the accounts showing at 300,000 that in reality is actually worth 400,000. Now, if you're preparing a small company set of accounts, you can use the accounting policy where you revalue your properties to market value each year. And any adjustments through this will be put through the profit and loss account. So what we're now going to be doing is the 300,000 asset we've got on your balance sheet, we are going to be increasing that value to 400,000. So now we've got an extra 100,000 that we are going to be putting in this revaluation reserve, which is basically saying I've not actually got that money, but the value of it has gone up. So I'm going to acknowledge I've got this potential value that I'm going to get in the future. Now, we've got a few things I want to kind of cover today. How it happens, what the actual transactions are, so you can understand what is going on in the background for the accounting adjustments and what disclosures you're expecting to see, as well as what the tax implications are. So what is actually happening when we say, oh, we've now got 100,000 that we're going to increase it by? From an accounting point of view, we are now going to be debiting, so increasing in value, your property, the asset that you've got. The opposite side of that entry is going to be, we're going to credit your profit and loss because you've now got extra income in your profit and loss account. So you're going to have a really good looking profit and loss account this year with whatever profits you've already made, plus this extra 100,000. So that's amazing. That looks brilliant. But what then will happen with those profits is they go and sit in your profit and loss reserve account on your balance sheet. That's increasing your profits. However, these are not treated as what's known as distributable ones because you can't take that money out because you've not actually realised, you've not made that profit yet. So what we will then do from an accounting point of view is we will reduce your reserves by that 100,000 and move that 100,000 into a revaluation reserve, which is basically saying this is what we've increased the value of the properties by, and at some point in the future we will move that back into our profit and loss. We'll move it back into that money we can take, but potentially only when we sell that property. This leads me on to talk about deferred tax, which I'm not going to talk long-winded today about deferred tax because there is a separate video on the channel which talks all about deferred tax in greater detail. But the general premise is now we also need to make a deferred tax adjustment because in essence, deferred tax is looking at the future potential maybe tax, as I'll describe it, and in the future maybe potential tax, we've now got 100,000 where we're potentially going to have to pay tax at some point in the future. Now, deferred tax works on the basis that we have to predict what tax rate we are likely to have to pay that 100,000 at. I know it all seems a little bit nonsense, but this is how we need to assess it. So that 100,000 will be either potentially in the marginal tax rate or it might be in the higher rates of tax for this company. So we're potentially looking at 26.5% or 25% that we need to make an adjustment for the deferred tax side of things. So this will adjust your profit and loss account because we'll put it in as a tax charge, a deferred tax charge, so you don't have to pay it, but it'll go in as a tax charge in your profit and loss account, and then it will get adjusted through those reserves on the bottom of the balance sheet. Let me show you a quick example of that, just so you've got it in front of you. Now, we've mentioned deferred tax, so let's continue on the tax vein for a moment. Now, our deferred tax, we've said, is a potential future maybe tax. You don't have to pay it. What about your actual corporation tax? What is the impact on that? Well, the impact on that is it's basically put on your tax calculation, so it will be there. However, just because it's there, we're going to actually add it back, so you won't actually have any tax to pay on this adjustment, because it's not a realised gain. It's not something you've made. It's just an accounting adjustment that we're putting through. So on that basis, putting through a revalued amount will not have any impact on your actual physical tax payment that you need to make. The key impact that it makes is it will have an impact on your distributable reserves, and that's the bit that potentially may be something to be just aware of. So let's move on to how you determine what this value is and follow on with our disclosures. So who makes the decision of what it is valued at will probably come down to a mix of several approaches. Now, the most formal approach is to actually go and get a valuer to come out and properly value all of your properties and have a proper valuation report. However, obviously there is a cost to that, and you don't necessarily need to do that every year. However, there may be years where you do have refinances, so a value for mortgage purposes is probably a good indication of what the value your property is. So if nothing else, that might be a point where it sparks a value for your properties if they are different. Or alternatively, it can simply just be your director's valuation, but that needs to probably be based on comparables or other properties in the area to give a reasonable valuation of what they are. Depending on what valuation is chosen, this will need to be disclosed, which leads us very nicely onto the disclosures that we need to show in our accounts. So in our accounts, we will have a specific investment properties note, which will show our total value of properties, our cost, our brought forward cost, less any disposals, adding on any additions, and adding on any valuations that have happened in the year to give us what last year's brought forward value was and this year's carry forward value is. And that will show the picture of what is happening. In addition to this general value on your investment property note, we also now need to show what the cost value is and what the valuations have done to give us the final value that we are showing in the accounts. So that one again is a relatively straightforward one, as it will show what historically the cost of your properties was, and then any revaluations on a year by year basis. When they've gone up, they've gone down, to show where things are sitting as of today, or as of the date of the accounts. The additional elements to then this disclosure note is we now also need to disclose the value of the properties at cost, and also if it had been depreciated over the period of time since ownership began, how much depreciation would have been included if it had been depreciated. So check out the video on depreciation if you're not sure what depreciation is, but basically depreciation is the reduction in value of the asset. So if you think of a computer, is always a good one from my point of view. You buy a computer and after 3 years it's definitely not worth the same value that you originally bought it for, mainly through advances in technology, use, deterioration, it may have got slightly damaged. All those things mean each year the value of the computer is going down. So in essence, with our properties, they are looking at it going, well, you've had it this many years, the wear and tear, the impact of people living there, the cost will have gone down. However, we obviously know that's not quite how the property market works, and generally property prices will remain either static, they go down every so often, and then they generally, over a period of years, they do tend to increase in value. So we just need to show this disclosure note that if we had depreciated it, what would the value of that property be as of that point in time. And the final part of our disclosure note is to disclose who the valuer of the assets is, who the value of those investment properties is, and the date that that valuation has been completed. So generally this will be, if you're doing it yourself, the properties have been valued by the directors as at this year, at the year-end date. And they are the key things we need to disclose. So as you can see, we've got the full list of the additions, the revaluations, we've got the cost and the valuations information, and then we've got the depreciated value, if it was depreciated, and then who has actually done the valuation. So as you can see, there is quite a few points that we have to detail in the investment properties note to ensure we've dealt with the revaluation side of things. The final piece of the puzzle is if there has been movements in the revaluation reserve, there will be a note further down in the notes which shows what the adjustments have been to the revaluation reserve as well. As you can see, with the revaluation policy in place, there is a few add-on things that you need to do when you're revaluing the property, and a few additional disclosures that need to be made while you're doing this approach. If you make no revaluation in a year, these notes will still be there. It's just there won't be any revaluations, and it will basically be saying that the revaluation is stating it's actually the same as it was last year. So just not making any changes in the year doesn't mean the notes are not necessary. It just means they basically won't change probably from the previous year, apart from the depreciation amount, which will be an extra year that you've owned the property. In summary, there's a few things to be aware of when you are revaluing your properties, and what the revaluation reserve is and where it fits into the accounts. Generally, this will all be done by your accountant in the background, but hopefully this has given you a bit of an understanding of how it fits together and what's happening in the background on your behalf. Hopefully today you've got an idea of what a revaluation reserve is and how it all comes about. So when you do look at those accounts and you see a line which says revaluation reserve, you've got an idea of what is going on. If you do have any questions, please do leave a comment. Please like the video and do subscribe to the channel. And let's make tax less taxing. Let's make tax less taxing.